Welcome to Sophie Daddy's channel. Today, we're diving deep into a strategy that really separates the pros from the amateurs. We're talking about building a precision instrument for your directional trades. This is the Debit Spread Playbook. We're going to move way beyond just buying simple calls and puts and step into a world of real structural advantages. But first, let's talk about the big problem this strategy is actually designed to solve. So let me ask you, are you tired of this? You make the right call, you pick the right direction, but you still watch time decay, that relentless theta, just bleed your premium dry. It is, without a doubt, the biggest frustration for option buyers. And today, we're going to talk about the fix. Okay, so let's put these two head-to-head. Over on the left, you've got your classic long call. Yeah, it's expensive, you're in a constant fight against the clock, but it has that lottery ticket dream of unlimited upside. But look to the right, the bull call spread. This is a defined risk structure. We're reducing our cost, we're slashing the negative impact of theta, and the trade-off, we cap our upside. And you know what? That trade-off is the entire economic engine of this strategy. It's how professionals stay in the game for the long haul. All right, here's our roadmap for this explainer. First, we'll cover why this is such a huge upgrade for any serious trader. Then, we'll break down the anatomy of the trade and really dig into its strategic edge. After that, we'll talk about building the perfect spread, compare it to credit spreads, and finish up with what is absolutely the most crucial part, managing your risk like a pro. Let's be really clear about something. A debit spread isn't just a slightly different way to buy an option. You need to think of it more like a sophisticated financing structure. Yeah, you're still expressing a directional view, but you're doing it in a way that intelligently manages your capital and fights back against the corrosive effects of time. So here's the key. We buy the option we want for our directional bet, right? But then we immediately sell a cheaper, further out of the money option against it. That sale brings in cash, a credit, that directly lowers the cost of our trade. By doing this, we give up that unlimited home run potential, but what we get in return is a significantly higher probability of turning a profit on smaller, more realistic market moves. All right, let's get into the blueprint and see exactly how these are built. We'll look at the two main types, the bullish version and the bearish version, and you'll see the logic is perfectly symmetrical. So, for a bullish view, we're working with calls. It's simple. First, you buy a call at a strike price you think the stock is going to blow past. Then, you sell another call at an even higher strike price. The money you get from selling that higher strike call lowers your total cost. You end up paying a net debit. And that debit, well, that's the absolute most you can ever lose. It's simple and it's defined. And if you're bearish, we just flip the script and use puts instead. We buy a put at a higher strike, expecting the stock to fall below it. Then, to help pay for it, we sell a put at an even lower strike price. And again, we pay a net debit to get in, and our risk is strictly limited to that amount. No surprises. Now, you might be thinking, why go through all this trouble? Well, the strategic edge isn't just some theory, it is purely mathematical. Let's look at a side-by-side comparison, and you'll see the data-driven case for why spreads are just so much better for capital efficiency. Okay, check out these numbers, because this is where it gets really interesting. For a stock trading at $100, buying that naked call costs you $500, and it needs the stock to climb all the way to 105 just for you to break even. Now, look at the spread. Our initial outlay is 40% less capital. And, crucially, our break-even is way lower at 103. This means we start making money sooner and with a smaller move in the stock. We are literally trading away that long-shot unlimited upside for a much, much higher probability of success. And the advantage carries over to the Greeks. Because we have that short option working for us, our net delta is lower, which just means a smoother P&L ride, fewer heart attacks. Our theta decay is dramatically reduced, and because we are net long vega, we actually benefit if implied volatility rises after we put the trade on. This makes debit spreads an absolutely fantastic tool in low volatility environments. So, how do we actually build the perfect spread? This isn't about guesswork, right? A professional framework always starts with the macro environment, specifically the price of the options themselves. This right here perfectly illustrates the core decision. Think of yourself like a store owner. You want to buy your inventory, our debit spreads, when your wholesale prices are low. In options, wholesale price is implied volatility. So when IV rank is under 30, options are cheap. That's the perfect time to be a buyer. When IV is high, options are expensive, and we should be looking to sell that premium with credit spreads instead. Okay, now for picking our strikes. Professionals don't just guess. They use a kind of rule of thumb that gives them a statistical edge. It's known as the 70-30 delta rule, and the logic behind it is what makes it so powerful. So here's the logic. We buy the 70 delta option, which is already in the money. This means it has a super high correlation to the stock, so it starts working for us from the very first tick. We then finance that purchase by selling the 30 delta option. And the beauty of this is that the 30 delta option has roughly a 70% probability of expiring worthless, which is exactly what we want our short option to do. This simple structure gives us a high probability trade right out of the gate. Let's clear up a really common point of confusion. When do you use a debit spread versus a credit spread? I mean, they can look pretty similar, but they serve very different tactical purposes. This is the fundamental question you have to ask yourself every single time. A debit spread is a directional bet. You're betting that the price will move to a specific target. A credit spread, on the other hand, is a bet that the price will not breach a certain level of support or resistance. So one is offensive and directional. The other is defensive and area-based. Now here's a real professional level edge, especially for bearish trades, because everyone is always buying crash protection. Out-of-the-money puts are almost always more expensive than out-of-the-money calls. This imbalance is called the volatility smirk. A bear put spread lets you take advantage of this by selling that expensive high IV put to finance your bearish bet. You're basically getting a subsidy on your trade that you just don't get with bull call spreads. Okay, listen up, because this is the most important part of this entire explainer. Getting into the trade is maybe 10% of the game. Professional profits and losses come from the other 90%, your management and your risk control. These are not suggestions, okay? These are hard and fast rules from professional trading desks. First, always take your profits at 50% of the max potential. That first half of the profit comes easy. The second half is a slow, painful grind against risk. Second, get out of all trades before you hit 21 days to expiration. This is to avoid the explosion in gamma risk. And third, never, ever roll a losing debit spread. Don't throw good money after bad. Just take the defined loss and move on to the next high probability setup. Now we have to talk about the boogeyman of spread trading, pin risk. This is where your so-called defined risk trade can turn into an undefined, unlimited risk nightmare. And it happens when the stock closes right at your short strike on expiration day. Just imagine this nightmare scenario. Your bull call spread should be a max profit trade. The stock closes a single penny above your short strike. You go to bed happy thinking you've won. You wake up Monday morning and you've been assigned 100 short shares of stock, your protective long call has expired worthless, and the stock has gapped up huge against you overnight. Your small defined risk trade is now a massive, unlimited risk loss. The rule is absolute. Never hold a spread through expiration if the stock is near the short strike. You have to close it. So, the takeaway here is this. Moving from buying naked options to structuring spreads is the first real step in graduating from a speculator to a risk manager. It's about building a trading business based on probabilities, capital efficiency, and tight risk control. You now have the professional's playbook for building the trade. The only question left is, will you manage it like one?